Hello and welcome to the latest in our quarterly webinar series, A Unified View of SME Credit Risk from Dun & Bradstreet. So this is an economic pulse check, should take about 10 to 15 minutes, where we're looking back at all the kind of big political events we've seen this autumn and the type of monetary and fiscal policies that have come off the back of that, and also how that could impact the fortunes of UK small businesses moving into next year. So my name is Stephen O'Toole. I'm a Senior Marketing Manager here at D&B, and I'm with two of my colleagues today on this pre-recorded webinar. We have Ravi Sidhu, who's a subject matter expert on all things credit risk. And we also have Grant Hickson, who's a Senior Economist in our Country Insights team. So if we move on to the first slide, fair to say that the last few months have certainly been eventful from a political perspective. If we start from the top, we obviously had the UK general election on the 4th of July. That ushered in a new Labour government with a clear mandate for change. And I think as soon as they came into office, there was much anticipation about what they would announce in their autumn budget at the end of October. Obviously, that budget has now come and gone. There's been much talk around the implications on things like national insurance contributions, minimum wages, etc. But that was closely followed after that by the US presidential election, which saw the return, obviously, of Donald Trump to the White House in early January of 2025. So that his re-election is going to obviously have major implications for the globe. But one of the things that many people have been focusing on and trying to anticipate is what will be their trade policy, and will we potentially see the reintroduction of tariffs moving forwards. We've also had two big announcements back in the UK during November. We had the Bank of England Monetary Policy Committee with their interest rate decision on the 7th of November, deciding to bring interest rates down by 0.25%. And then we had our GDP growth update on the 15th of November, which saw rather sluggish growth in the third quarter of the year at 0.1%. So obviously you can look at all of those events individually, but in the round, they are going to have a big impact on the fortunes of UK businesses moving forward. This is just a selection of some of the coverage and the types of commentary that we've seen in that time. Obviously, a lot of coverage around the return of the Labour government, anticipation of what their new tax regime would look like with that budgetary announcement. And then once that statement was given, a lot of the focus turned to potentially some of the policies being maybe inflationary and how it would impact small businesses, which may have been struggling already with such a tumultuous last few years with things like the pandemic and rising energy costs. And then obviously, last but not least, the return of Trump to the White House, much anticipation around many policies that could come into effect from next year, but especially for a small business lens, what could happen with tariffs and how that could impact the UK economy as well. And what I'll do now is hand over to Grant, who's our senior economist. He's going to look at the impact of the UK budget for small businesses and what that could potentially look like, as well as some of the more themes we've been seeing from the US as well. Over to you, Grant.
Thanks, Stephen. I think your introduction sets us up nicely. Let me go into some detail on the H2 markers that you've identified. But before I do that, here are, I think, three kind of key takeaways. Number one, I don't think that all SMEs are badly affected by the budget. And for some, I think there is some upside. Secondly, the trade policy topic of the moment, US tariffs, might not have a huge impact on the UK economy overall. And finally, I think we are likely to see further interest rate cuts, just albeit at a slower pace now. So looking back, we had the general election in July, which returned a large mandate for change for a new Labour government. And after the election, there was a 4-month wait for the new government's fiscal announcement. So we had a protracted period of wait and see. When it came in October, the budget turned out to be expansionary, more expansionary than expected, with policies aiming to boost real GDP. The central theme was to invest to promote growth, to restore economic stability. But as with any budget, there was trade-offs. And as with a lot of these things, the effects on businesses will be mixed. There's some short-term and there's some long-term impacts. And I think the impact also varies by industry. There's clearly concern among businesses about the almost immediate additional costs from the increases to the minimum wage and to the national living wage, and also to national insurance contributions, and the rated reduction in the threshold at which employers start paying that tax, which take effect in April next year, about how businesses might be able to absorb those additional costs, if at all, and it may even affect future hiring plans. Clearly, those businesses that have a relatively higher share of labour, those with large workforces, particularly in lower paid roles, think about retail, hospitality, are likely to face a relatively high impact. To some degree, higher wages might improve employee retention. Does retention outweigh higher operating costs? Looking where businesses might find some positives, the headline corporate tax rate was capped at 25%. Full expensing of capital allowances remains in place, allowing for tax deductions for certain types of capital spending. And business rate relief is still available, but at a lower rate of 40% rather than 75%. The employment allowance has been increased from £5,000 to £10,500, and the £100,000 cap will be removed. And so that will take the pain off the smallest businesses. Specific investment plans again illustrate the varied impact by industry. More than £20 billion has been allocated to R&D in STEM-related sectors. So SMEs in tech, innovation, engineering, medical science, those kind of industries, they may benefit from this financial support. If we move on to the next slide, please. So in short then, the budget presents both challenges and opportunities for UK SMEs. The government is looking to balance the books, but also provide support to SMEs that are still struggling with difficult macroeconomic conditions. And in that respect, there isn't going to be a one policy fits all business strategy. The budget is perhaps a mix of easing pressures in places, but new pressures in other areas. And to some degree, putting the budget to one side, the future of business growth, employment and investment remains uncertain, perhaps more uncertain than usual. And some of that uncertainty comes from beyond the UK. So, for example, I would stress that we shouldn't ignore the impact that the incoming US administration may have on UK SMEs. Some of the proposed policies during the US presidential election campaign look to potentially be inflationary for trade partners with the US, such as the UK. Also, in the US, we might see immigration rule changes, regulation changes, taxes, tariffs. Proposed US tariffs would be a major change in US trade policy. We may see significant strength in the US dollar next year. The impact on UK importers into the US on a small open economy like the UK may mean UK prices come under pressure as producers push additional costs onto consumers. And two things to mention in some back-of-envelope calculations. One is that UK exports account for around 33% of total UK GDP. And the second thing is that the US is the UK's largest export market for goods and services. And it takes around 1/5 of total UK exports. So, we're looking at around 20% of 1/3 of UK economy that's potentially affected. So the impact would not be insignificant for the overall UK economy, but potentially not massive. But it would clearly be a big issue for UK firms that export mainly or exclusively to the US. I think it's important to note, though, that those policies are not yet in effect, and we should wait to see how announcements become actual policy. Let's finish by turning back to the domestic economy. So we've had the budget, fiscal policy, and we've looked at the potential impact on the external side from the US. Let's take a look at UK monetary policy. So the Bank of England continues on a path of easier monetary policy that it started effectively in August. But the bank will have since considered the likely impact of the UK budget and the likely impact of potential incoming US policies. And to some degree, the bank's hawkish sentiment at the November meeting reflects this, and it makes the December cut less likely than earlier expected. Beyond December, and to the extent that UK government spending and potential future US trade policies might be inflationary, we're now seeing markets repricing a more gradual path for UK rate cuts. And that means borrowing costs potentially staying higher for longer. On the dovish side of the bank sentiment, the economy virtually ground to a halt in Q3 when real GDP growth slowed to 0.1% from 0.5% in Q2 and 0.7% in Q1. Now, a slowdown in growth was expected to some degree. We had uncertainty around the new government, but more importantly, there was uncertainty around the budget, about what it might contain in October. And we still had high interest rates. And those things have weighed on business and consumer spending. So low growth goes in the column under reasons why we are likely to expect further rate cuts. And perhaps the economy had a bit less momentum than we previously thought. The monthly data showed that GDP actually fell in September, which is concerning. But we've moved past the budget now, and we might see something of a small rebound in Q4 as consumer spending picks up. And that could be positive for business solvency, which Ravi will take us through next.
Thanks, Grant. So I guess the question remains is, what could this mean for SME lending? And I guess for the market overall. There's certainly been a tilt towards more caution following our last quarterly update that we gave. And in addition, the most recent insolvency numbers for Q3, they still remain elevated and have been for the last 2 years or so. The real call-outs here are construction firms, and yet again, it's a sector that's being disproportionately affected by insolvency. The number of firms failing in this sector is dropping on the quarter, but still remains around 15% of all insolvencies in the UK. So that equates to about 2,500 construction firms so far this year. Similarly, restaurants have fared equally as bad, and there's been a similar number that have gone to the wall. And it's possible that the interest rate cuts now won't feed through quickly to all businesses. And it's hard to see how some of these headwinds will diminish anytime soon. And of course, there's going to be a knock-on impact to lenders' confidence towards SMEs based on all of those points that we've touched on so far. But there are areas where we think there could be some optimism. There are other factors at play here. Recently in November, the Chancellor of the Exchequer, Rachel Reeves, delivered her first Mansion House speech. And in that, there was a headline around the easing of regulation, or as she phrased it, regulating for growth. Now, among other things, there was a focus on sustainable finance, the use of technology to reduce fraud in lending, and greater collaboration between the financial services sector and government to support lending to small and medium enterprises. So that's certainly an area which could shift the momentum in the right direction. And it's very much aligned to Dun & Bradstreet's unified risk view. What remains to be seen is the impact of this over the coming months. And I'm sure listeners will be keen to take a deeper dive when we reveal a more detailed analysis in Q1 next year and going forward throughout 25 on this and other topics. Back to you, Stephen.
Thank you, Ravi and Grant, for those insights and commentary. So on the previous slide, Ravi mentioned the D&B Unified Risk View. This is a new innovative solution which we just launched in November, basically taking the strength of D&B commercial data and adding the consumer picture through TransUnion data to give a really holistic, data-driven approach to credit risk for businesses of all sizes. So thank you for your time today. Looking forward to seeing you on the next webinar in Q1 of 2025. And if you are keen to find out more about the Unified Risk View, please do search for it online or follow the call to actions at the end of this recording. Thank you and see you soon.